Well, it was a big day for the stock market as both the S&P 500 and the Russell 2000 hit all-time highs. And for the S&P 500, that was the first time that occurred since late January. In addition to that, financial media has been reporting that starting tomorrow, we will now be entering the longest bull market in history. So as a reminder for everybody that tried to be bearish along the way, today is a reminder that stocks naturally have that ability to levitate higher. Might not do it every single day or every single week or every single month, but generally speaking, over the long term, the stock market is an exceptional place to get good returns for your investment dollars. We'll take a look at what all the various postures are after this big day on the market. Then we're also going to look at a trade setup here within the consumer discretionary space where we've been seeing a little bit more interest within retail stocks. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 21st, 2018. First of all, if you are new, welcome to these videos. We'd encourage you to click subscribe on YouTube, and while you're there, go into our description area and sign up for our email distribution list as well, where you'll be given access to the stocks within the S&P 500 that are giving us overbought and oversold cluster signals using the market forecast indicator. In addition to that, we're also heavy users of Twitter. I'd encourage you to follow me at Brandon Van Zee. And anytime you see these Market Outlook posts, if you wouldn't mind clicking like and retweet, that lets us know that you appreciate them and you want us to continue to do those going forward. And then we're also on Facebook. Feel free to jot down that web address embedded in the logo in front of you if you want to join our group there. All right, let's go ahead and dive into the analysis of the markets now. As you can see, I've got chart 4B pulled up here for those of you that are premium market scholars that want to follow along with our charts here during the presentation. This is 4B. And as a reminder, this particular chart setup here is just going to allow us to see all four of our major U.S. charts all in one screen here. And as a reminder, when you see this label show up, notice up here on the S&P 500 it says yearly high today, and we also have that down here on the Russell 2000. So it's just one more way to identify whether we're hitting new highs or not. So we can see that that did show up in those two cases. However, we did not hit a new yearly high on the Dow Jones. Notice this is just a 3-month chart, so they likely were a little bit higher back in January. And then the NASDAQ has been a little bit of a laggard here recently. Been having a lot of good conversations about that in some of my top-down analysis classes recently, where we've seen kind of this transition away from some of the go-go technology stocks out there. So you have found that the NASDAQ has been a bit of a laggard here, which isn't necessarily the healthiest of signs. Notice that the NASDAQ actually still has a bearish posture using the market forecast indicator. I know that because we've got that pink background color. Remember, when you see the pink background color, it means bearish using the green line on the market forecast, which is the intermediate term time frame. So remember, just because we use that as kind of our default setting as far as setting posture doesn't mean that that has to be what you use. In the end, some of you are going to be much more active than we are. On the other hand, some of you might not be active at all, and so to each their own there. But we generally look at that intermediate term time frame to establish our posture here, which is kind of letting us establish our trades and our positions for the next, let's say, 1 to 3 months or so. So with the NASDAQ, we still have a little bit of skittishness there, but we do have some very strong markets with our other three markets there, or indices, I should say. Russell 2000 actually had a very nice day. Not only was it up 1.14%, which was the biggest move of these four, but notice that we closed near the highs of the session there on the Russell 2000 as well. Of course, that tracks the small cap stocks in the United States. Well, we closed at new all-time highs here today after kind of a long consolidation period there. Now, we do have an iron condor on the IWM, which is the ETF that tracks the Russell 2000 for this Market Outlook video, but I just checked it before my presentation here, and we're still within the range of our two sold strikes, and we only have 3 days left, so I think we're going to be in good shape on that. But be aware that, you know, at this point going forward, you might assume that we now have kind of a new area or trajectory for the Russell 2000. In the past, we had considered it very sideways. It's very likely, or at least possible, that we are now going into what's known as more of a bullish phase for that Russell 2000 as we kind of broken out of that consolidation there. One thing I did want to point out regarding the S&P 500, and remember, you can always right-click on any of these charts and just go to maximize sell. in order to see them in greater detail. But I did want to point out that this is not the most bullish of candles out there. It's not a perfect gravestone doji or tombstone doji, depending on who you ask on that vernacular there, but it's very close. And generally the idea there is after you've made a move higher and you're at what could be perceived as some sort of a resistance area, you kind of put in one of these candles where you start and you end the day near the same levels, which also happen to be the lows of the day. So kind of the psychology behind that is that throughout the day itself, you found that the bulls at the beginning of the session were likely pushing the market higher, but by the end of the day, you saw the bears take over and kind of squash the hopes of the bulls. Now, again, we don't want to make too much of that. We hit all-time highs here today, and we were up 0.21% when it was all said and done on the S&P 500, but we were up a lot more earlier in the session. So it did seem like the bears weren't willing to just simply roll over here in today's session. So we'll keep our eyes on that, but remember, from a posture setting perspective, we still have that green intermediate line in the upper reversal zone above 80, and therefore we still consider the S&P 500 bullish. Let's go ahead and take a look at a new chart setup now. Let's take a look at chart 4C. This will be our 3 green arrows chart setup. And the background colors here will be a little bit different than the ones that we just looked at a moment ago. In this case, if you see a green background color, it means that you have what's known as 3 green arrows, which is just kind of a fun way to talk about 3 different technical indicators: the 30-day moving average, MACD, and the stochastics. And so in the case of something like the Dow Jones right here, notice that the Dow Jones has 3 green arrows. We know that because, first of all, the background color is green, and we also have the green arrow right there on the moving average. There's our green arrow on the MACD and the green arrow on the stochastics. We have the same thing going for the S&P 500. In fact, that's new as of today. Dow Jones actually got 3 green arrows as of yesterday, but the S&P 500 just got that here today. And then the Russell 2000 has had it for a couple of days at this point, and just continues to see some interest there, whereas the NASDAQ remains, again, our laggard from this perspective as well, where we don't have 3 green arrows or 3 red arrows. We kind of have a mix of both. We have a green arrow on the moving average, we have a red arrow on the MACD and the stochastics. If we were to look at a longer term view of those same 4 indices, let's go to chart 4D now, and this will look at a 3-year chart in each of these cases here. And what we're looking for on this, which we call the 1040 crossover method, is for the orange line, which is represented by the 10-week moving average, crossing down and below the blue line, which is the 40-week moving average. Well, at this case, we don't really have much to worry about there. There was a time here a couple of months ago where it seemed like, yeah, maybe the Dow Jones could have that possibility of a crossover, but it's recovered nicely. And although we're not hitting new all-time highs on the Dow quite yet, we still have price action well above those moving averages there, and those moving averages are actually separating away from one another, which tells me that there's not going to be any sort of a crossover anytime soon. And remember, these particular kind of crossover signals don't happen regularly. The last time we saw these was over 2 years ago. So had you been bullish this entire time, you'd have done very well. Remember, there's people that want to fight this market, and we see it, and we hear from folks regularly saying that, yeah, you got to be bearish because of X, Y, or Z. Maybe they don't like the politics, or maybe they don't believe that the tax cuts will hold, or whatever their excuse is. They want to be bearish for some reason, yet the markets continue to go higher and higher and higher and hit new all-time highs like we saw with the Russell 2000 and the S&P 500 today. Let's take a look now at some 12-grid analysis here. Let's go over here to our intermarket analysis 12-grid to start things off. And as we look at this, as a reminder, when we look at the background colors of these charts, we're looking at the green representing bullish intermediate term posture and the pink representing bearish intermediate posture. And this is chart 4E for those of you that are premium market scholars that are following along at home. And what I'm generally looking for here are strong trends or potentially reversals of trends. One thing that we've been really looking at recently is the US dollar. It is kind of interesting that the US dollar has now fallen for about 4 or 5 straight sessions, but look where we're standing right now with the US dollar, at least with UUP. We're right at that rising moving average. In fact, we touched it earlier in the session, so if I were to right click on that and go to maximize sell, you can see that at the lows of today's session we are effectively touching the moving average, and then it did bounce off of that on an intraday basis. Still closed lower on the day by 0.59%, but the point that I'm trying to make here is that more times than not, when we've had these mini pullbacks in the US dollar in the past, they've actually been buying situations, not selling situations. Whether this time is different or not, we won't know until the future unfolds. But what we can say, judging by the past, is that generally when we've pulled back to that moving average, it's been a time of stability, and it's been a time where the US dollar has found some strength and wanted to go a bit higher there. Volatility was up today. So for those of you that track the VIX for your various options trades, the VIX was actually up 3% today. That was a bit peculiar. Remember, normally the VIX moves inversely to the markets. And so on a day when the S&P 500 and the Russell 2000 hit new all-time highs, you wouldn't have necessarily expected the VIX to be up. Now, it wasn't up much. Remember, the VIX moves in big, violent movements out there. So a 3% move on the VIX is kind of a non-event, but you would have expected the VIX to be down on a day like today. So maybe there's a little something there. Again, going back to the candlestick formation on the S&P 500 wasn't the most bullish thing on planet Earth at today's close. Maybe there's a little bit of fear creeping into the system there at the end. So we'll have to keep our eye on that to see if that leads to any sort of selling pressure. But right now, obviously the most of the market postures continue to be bullish. Other things to be aware of: the REITs have been fairly strong asset class. We did pull back on the REITs here today. So when you see 0.61% pullback there, got to take that in context. Remember, the REITs have been one of the best places to be here recently. Notice that if you look at VNQ as your proxy, which is the ETF that tracks a lot of REITs, it's been in a strong upward trend there as well. So maybe another couple of days of pullback, hard to say there, but again, we remain above a rising moving average right there. Junk bonds had a decent day. Junk bonds were up 0.2% here today and closing probably, maybe not quite at a 3-month high, but very, very close to a closing price 3-month high. Probably the only other candle on the board would have been that one back in June. So keep an eye on junk bonds. It's possible that they're looking to break out here. It's been kind of interesting to watch the Treasury yields fall the way that they have. Notice that Treasury yields have been falling here since the beginning of August, basically in a straight line. So the 10-year Treasury yield is only at 2.84% right now. And so when Treasury yields are falling, that generally helps support things like the REITs and utility stocks. All right, let's go ahead and take a look at our next 12 grid now. This time, let's look at the foreign stock markets 12 grid. And as you can see here, it's kind of a mixed bag from bullish versus bearish perspective. I'd say that the chart that probably looks the best to my eye at first blush is down here, Israel. And that's the one that I've been notating quite often in these presentations. It seems like this is one of the countries, at least, that has been holding up better than others. And so while Israel was down 0.46% today, keep in mind that this thing just got done rallying for about 3 or 4 straight days there. And we're very close to 3-month highs in this case. We're still up 7% in the Israel stock market over the last 3 months. Despite today's pullback. So that one kind of remains our strongest from a trending perspective. India has been holding up well, especially compared to their emerging markets brothers and sisters. India is up there near a high over the last 3 months as well. Not quite back to where it was here in the first week of August, but right there knocking on the door of that. So India up 6.5% over the last 3 months. That's been another strong performer. Russia has been trying to kind of get out of that oversold condition. Notice all those little green dots showing up there. That's telling us that that particular security has what's known as oversold cluster signals using the market forecast indicator. And so we have had a little bit of a reversion to the mean in the last 3 days to kind of get out of that particular signal. On the other hand, look at Brazil. Brazil went from having it's kind of interesting actually with Brazil. We went over here with this green dot showing us oversold signals, ripping all the way up here to the point where we got a red dot, which is telling us overbought signals. And then that red dot went straight down to where we are now at this green dot again, once again showing us oversold signals. So that doesn't always happen that way, but it's kind of interesting when it does. So we might very well be to a point on Brazil where we do still have a bearish posture on it, which is what that pink background is telling us. But for those of you that are looking for a counter trend type of a trade, keep your eye on it, because where we find ourselves ourselves with EWZ is right back in kind of that old horizontal support area between June and July time period. So if you do start seeing a bounce out of EWZ in the next couple of days, that might be an opportunity to take a reversion to the mean type of a bullish trade in that particular case. Let's go ahead and now take a look at the US markets from a 12 grid perspective. As a reminder, the S&P 500 is going to be the chart in the upper left, and then all the rest of these 11 charts will be the 11 sectors that make up the S&P 500. And as it stands right now, there's only two bearish charts on the board. It's technology and energy. And that's somewhat rare, especially in the case of technology. And I kind of alluded to that a little bit earlier in the presentation today, that technology is starting to fall out of favor a little bit. You know, we saw that through the NASDAQ itself, which, you know, the NASDAQ isn't necessarily 100% technology oriented, but can oftentimes be used as kind of a proxy for the high growth technology style of companies out there. But now we kind of have extra confirmation here going directly into just the tech stocks within the S&P 500, and it does show us that pink background color telling us that we now have that intermediate term line at 71.99 and falling, and therefore it's somewhat bearish. One thing that I did notice when I was doing my sector selector tool over the weekend, let me pull that up here as a matter of fact so that way we can have a chat about it. Remember, for those of you that are premium Market Scholars subscribers, you're going to get access to not only the top half of the sector selector, but also the bottom half down here that contains a lot more details. But for right now, let's just go ahead and take a look at the top half to kind of give us a sense of trends of different sectors out there. And one thing I wanted to point out was right here. Technology ended Friday night at 7th. Now, that is very rare. For those of you that have been following me over the years, you'll know that technology, more than any other of the other 11 sectors out there, has spent more time in those top 3 or 4 slots than any other sector. So it is somewhat rare to see technology slipping down the ranks into the bottom half of the rankings. It's very, very rare to see that. Now, there have been times in the past where you kind of wanted to count technology down and out, and then they came roaring back. So I don't know if that's going to lead to anything, but what I do know is that, as you can see, if you look at these yellow pegs here, in the last 3 months, this is the lowest ranking technology has had. We also saw that a lot of those defensive areas up here at the top, utilities, real estate, healthcare, they remain strong. And then discretionary. This has been a very interesting kind of situation here as well, where along with those defensive areas, we found that all of a sudden retail stocks are alive and well. We talked about that last week as well with some of those stocks that were reporting earnings and the XRT hitting all-time highs. Well, discretionary continues to be very robust, and even in my Friday rankings, you can see that discretionary effectively went from 9th just a couple of weeks ago here in the purple to 2 weeks later being 4th. So there's a lot of firepower behind the consumer discretionary stocks right now. If I were to come over here, take a peek at that discretionary sector back on the Thinkorswim Paper Money platform, notice that it had a pretty good day where discretionary was up 0.79% here today, and we have new at least 3-month closing highs. That very well might be all-time highs there with XLY. So that one actually held up better by the end of the day than most of the others. You know, a lot of the other areas of the market actually closed near the lows of the day. This one actually still closed in the upper half of the range. So again, some resiliency there out of some of those discretionary names. And that then leads me to our trade application example here for the day. And so for that, I'm going to come over here to just a regular chart 4A, which will take us back to a 1-grid chart for the market forecast all by itself. And the stock I wanted to have a chat about was Kohl's, ticker symbol KSS. Now, as you can see here with this chart, as I pull up a 3-month chart, it had been largely a sideways tracking stocks for here about, let's call it 2 or 3 months at this point. But today was kind of an interesting situation where it reported earnings this morning. And a quick glance at what happened with earnings, they came in at $1.76, and analysts were expecting $1.68, so handily beating analysts' expectations. But you can see that it wasn't all roses for this company. What I mean by that is you can see the big range of this company. Remember, when you're looking at this chart 4A, you're going to have this label up here that says daily range that will be colored in either blue or orange. When it's orange, it means the daily range is greater than its average true range. To kind of give you a sense of, was today an outsized day or an undersized day in terms of total range from high to low? So today was definitely an outsized day. But at one point during the day, it appeared that the bears wanted to take control. In fact, this stock was lower on the session at one point during the day, but that's when the bulls really started to take hold and push Kohl's stock higher and higher and higher, and we almost closed at the highs of the session when it was all said and done. So remember context there, because S&P 500 closed near the lows of the session. The consumer discretionary sector, which Kohl's is part of, did close closer to the highs of the session, but not nearly as close as Kohl's itself did. That was very, very close to the highs of the session there for Kohl's. So kind of had a bit of a bullish engulfing type of a pattern there. You saw strength of the fight back of the bulls versus the bears on an intraday basis. And of course, you still have a bullish posture. We know that, of course, because we've got that green background color right there. We can also read the label down below here where it says 76.8 and rising. So we would view that as a bullish posture. So we'll see if this can maybe lead to greater upside potential. Now remember, we were mostly sideways, and just because we are now closing at our new highs on a 3-month basis doesn't guarantee that it'll keep on going higher, but at least that's where the direction is tilting right now. That's where our path of least resistance is. So when I looked at this particular trade, there were a couple of things I wanted to bring to light. First of all, this is not a strongly uptrending chart yet. I think most of us recognize that. It was once a sideways tracking stock that has now tried to break out, but this is still not, you know, that really beautiful higher highs and higher lows type of a chart. So I didn't want to get too aggressive with the trade idea. We're just going to look at what's known as a bull-put spread, which is a way for us to kind of take a bullish opinion of the stock, but not do it aggressively. And what I mean by that is, ideally, we do want that stock that we sell a bull put spread on to go higher, but if it doesn't, and let's say that it kind of falls back into that sideways channel again, then we can still end up making some money on it even if it goes sideways. What we don't want to have happen is for it to just completely break down and go a lot lower. And so that's kind of the idea behind it. Remember, this is one of those strategies that does make money off of time decay. So even if we got into a bullish trade at $80.20 and we wake up 31 days from right now and it's exactly at $80.20, we would still win that trade. Whereas if you just simply buy the stock and it's still at $80.20, of course, you're not making any money there. So that's the nice thing about those bull put spreads. They make money off of time decay, and therefore even a sideways trading stock can still make you some money. All right, so what I thought we would do with that, first of all, I was initially going to go to the 76 delta, or I'm sorry, the 76 strike, and the reason for that is it had the 30 delta there. And while I could have made that work, so let me show you, if I go over here to right click on it and go to sell deep and wide, let's go 1 month, 2 strikes, and I'll show you that it was right on the verge. Now, these numbers actually did change here since I looked at it right before the market closed. It was at 24 cents right before I did this video, so it did drop to 23 cents. But that's right around that 30% return on risk. But as I looked at the chart and I asked myself, do I want to be short the strike at 76? I looked at the chart and I said, well, you know what? This at 76 was actually trading there earlier in today's session. How confident am I in that it's going to stay above that level going into the September expiration, 31 days from right now, if it's been trading there just earlier in today's session? So I kind of looked at this moving average down below here and I asked myself, is there a way that I can sell a strike closer to that moving average down there? Because you will notice that the last couple of times it touched the moving average, it didn't go below it. It touched the moving average and bounced off of it. And so if we have our sold strike around that moving average or below it, then we should be kind of bailed out in that trade idea if that pattern holds up and every time the stock goes to those levels, it bounces back up off of it. So I went over here and instead of doing the 76.75, I changed this to the 74.73. So I'm going to change that manually here. And this one did change as well. This one was at 23 cents. So sometimes these will change right there at the end of the day. Some of you are going to look at this and say, well, That's a $1 strike strike width there in that case between 74 and 73. And some of you that have calculated that before said that, hey, you want to get at least 24 cents of credit on every $1 wide vertical spread that you're selling. And that's generally true unless you have a good reason on why you would accept less. And so if you wanted to kind of get the calculator out here and determine how your return on risk would look with a 22-cent credit instead of the typical 24. Remember, you can just click the confirm and send once. That'll bring up your confirmation dialog box. And then just take $22, in this case with just one contract, $22 divided by $78. Notice that that is a 28.2% return on risk. So for those of you that are hardliners and say, I have to get at least 30% return on risk, then this is probably not a trade that you would take. On the other hand, for those of you that are a little bit flexible in your approach and you're saying to yourself, well, you know what, 28% is awfully close to 30%, and you get the added benefit of selling the 74 strike instead of the 76. Remember, that's $2 whole extra we're talking about there in flexibility. Remember that the 74 strike will be right down here near that moving average, as opposed to what we were looking at initially with the 76 being within today's candles range. So to me, that's obvious that I would rather give up a couple of percentage points in return on risk in order to have a little bit more safety in what I see from a technical perspective right there. So let's go back over here. And of course, you'd position size whatever's best for your own portfolio. Since this is just an educational presentation, I'm just going to leave it at one contract there just to kind of shoot the idea through. But confirm and send, review that one last time, and ship it off. All right, well, I want to thank you for joining me here tonight. It's always a pleasure to go to work for you. David will be back with you for the rest of the week as I've got a couple of days off scheduled. Remember that markets are generally doing quite well. S&P 500, Russell 2000, both all-time highs as of today. So from an intermediate term posture perspective, we remain bullish for the most part out there, with the slight exception of the NASDAQ being kind of a laggard there, showing us that technology isn't quite willing to go up at some of the same paces as some of the other sectors that are out there. But it does look like some of those areas like consumer discretionary are perfectly willing to continue to ride that trend of the market higher into the fall. So with that, I want to wish you all the best with your trades and your investments. Goodbye for now.